Did you know that over 70% of all trades on the US stock market are made by machines, not humans? We're diving deep into the world of high-frequency trading, a realm where algorithms and bots dominate, making decisions faster than the blink of an eye. This is a world where microseconds mean millions, and speed is the ultimate weapon. High-frequency trading, or HFT, is a type of algorithmic trading where computers execute a massive number of orders in fractions of a second. Imagine a trade happening in just a few microseconds. That's millions of a second. It's a speed so fast, it's almost impossible for our human brains to comprehend. And yet, this is the reality of modern finance. These lightning-fast trades have completely reshaped global markets, for better or for worse. So how does it actually work? Well, HFT firms aren't your typical investors. They aren't poring over company reports or betting on long-term growth. Instead, they're masters of arbitrage, exploiting tiny, fleeting price differences that exist across different exchanges. Let's say a stock is trading for $100.01 on the New York Stock Exchange. But at the exact same moment, it's trading for $100 flat on another exchange. An HFT algorithm instantly spots this tiny discrepancy. It buys the stock on the cheaper exchange and sells it on the more expensive one, all in a fraction of a second. The profit? Just 1 cent per share. But when you're trading millions of shares per second, those pennies add up incredibly fast, turning into millions of dollars in profits each day. The story of high-frequency trading really begins in the early 2000s. As financial markets moved away from the loud, chaotic trading floors and onto electronic platforms, a new arms race began. It wasn't about who could shout the loudest anymore. It was about who had the fastest connection. To gain an edge, firms started practicing what's known as colocation. They paid huge sums of money to place their computer servers right next to the stock exchange as data centers. Why? Because in this game, even the time it takes for data to travel through a few extra feet of cable can mean the difference between winning and losing. This relentless pursuit of speed has led to some pretty incredible technological feats. Companies have laid thousands of miles of fiber optic cables in the straightest lines possible across continents. They've built microwave towers to beam data through the air, because signals travel slightly faster through air than through glass fiber. They've even laid new, more direct undersea cables across oceans, all to shave off a few precious milliseconds from the time it takes to send a trade order. Billions of dollars have been poured into this infrastructure, all in the name of being just a little bit faster than the competition. But HFT isn't just about raw speed. It's also about information and intelligence. The algorithms driving these trades are incredibly sophisticated. Many use advanced machine learning to analyze historical data and predict tiny market movements before they even happen. Others have a more controversial strategy. They are designed to detect large buy or sell orders from big institutional investors, like pension funds. The algorithm then quickly jumps in front of that large order, buying up the stock and then selling it back to the institution at a slightly higher price. This practice, known as front-running, is a major point of contention and has many critics crying foul. They argue that high-frequency trading creates a fundamentally unfair market. It is a two-tiered system where firms with the fastest technology and the deepest pockets have an insurmountable advantage. Everyday retail investors, mutual funds, and even smaller institutions simply can't compete. They're always a step behind, trading in a market that seems to prioritize speed over fairness. Perhaps the most infamous example of HFT's dark side was the flash crash on May 6, 2010. In a terrifying 36-minute span, the Dow Jones Industrial Average plunged nearly 1,000 points, wiping out almost $1 trillion in market value. Investigations later revealed what happened. A large institutional sell order triggered a cascade of automated selling by high-frequency trading algorithms. These bots, programmed to react to market trends, amplify the initial sell-off, creating a vicious feedback loop of panic, exposing just how vulnerable our automated financial system had become. Defenders of HFT argue that it actually provides some significant benefits to the market. Their main argument is liquidity. HFT firms make it easier for everyone to trade, which is the small difference between the price you can buy a stock for and the price you can sell it for, from the biggest hedge fund to the smallest retail trader. And they deserve to be compensated for providing this service to the market. However, the reality is a bit more complicated. While HFT can add liquidity during normal, calm market conditions, that same liquidity can vanish in a flash when things get rocky. Many high-frequency traders are programmed to simply pull out of the market to avoid losses. This sudden withdrawal of liquidity can actually make price swings even more extreme. We saw this during the flash crash. Beyond stability, HFT also raises serious questions about market integrity. Some algorithms engage in tactics that walk a very fine line with market manipulation. This is where an HFT firm floods the market with a massive number of buy and sell orders and then cancels them almost immediately. The goal isn't to actually trade, but to create a flood of noise and data that confuses or slows down competing algorithms. These kinds of practices erode public trust and have led to urgent calls for stronger regulation. All around the world, financial watchdogs are grappling with how to oversee this fast-moving industry. In the United States, the Securities and Exchange Commission has implemented new rules to increase transparency and crack down on abusive practices. In Europe, a major piece of legislation called MiFID II introduced specific rules for high-frequency traders. But many experts argue these measures are like putting a Band-Aid on a bullet wound. They don't fully address the systemic risks that HFT poses. One of the biggest challenges for regulators is the sheer complexity of it all. The algorithms are proprietary black boxes, their code a closely guarded secret. It is incredibly difficult for outsiders to understand exactly how they work or to prove when they cross the line into manipulation. Plus, finance is global. HFT firms can simply pack up their servers and move to another country with more lenient laws, creating a regulatory race to the bottom. Is it right for a small group of elite firms to dominate financial markets simply because they have better technology? What happens to the integrity of the market when the pursuit of speed and profit outweighs the need for stability and fairness for all? These are tough questions with no simple answers, but they force us to think about the kind of financial system we want. Looking to the future, the influence of HFT is only set to grow. Emerging technologies like quantum computing could revolutionize the field, allowing algorithms to process information at speeds we can't even imagine today. Artificial intelligence is making these algorithms smarter, more adaptive, and better at navigating complex market conditions. But with these incredible advancements come new and frightening risks. The same powerful technology could be weaponized. Imagine a rogue state or a cybercriminal using a quantum-powered algorithm to deliberately destabilize global financial markets. It sounds like something out of a science fiction movie, but it's a scenario that regulators and market leaders must start preparing for right now. For most of us, the world of high-frequency trading feels abstract and far away, but its effects are very real. It influences the price of the stocks in your retirement account, the volatility you see in the market, and the overall structure of our financial system. Understanding this hidden world is the first step toward demanding a market that works for everyone. They need to invest in their own technology to effectively monitor a market that operates at the speed of light. We need to know how these algorithms operate and what impact they're having. And finally, we need global cooperation to create a consistent set of rules that ensures a level playing field, no matter where you trade. High-frequency trading is truly a double-edged sword. It's a stunning display of human ingenuity and technological power. But it's also a stark reminder that when we prioritize speed and profit above all else, we risk losing fairness and stability. The big question remains: who will be the guardian of that future, ensuring that the markets benefit all of us? Thanks for watching. Make sure to like this video and subscribe to our channel for more deep dives into the forces shaping our world. See you next time.